Banking and financial stocks, they are buzzing in trade after the RBI has announced a bunch of measures to shore up liquidity in the system. It'll infuse about ₹1.5 lakh in total over the next 3 months.
Federal Bank dips over 6% after the bank reported its lowest net interest margin in 16 quarters. The management tells CNBC-TV18 that provisions in the third quarter were taken at levels higher than required.
Kaynes Tech plunges in trade today, now down nearly 20% after revenue profit come below estimates. The company has cut its FY25 revenue guidance as well from 3,000 crores to 2,800 crores. The management tells CNBC-TV18 that it's execution delays in the third quarter that led to the revenue guidance cut.
Emami climbs close to 2% on the back of its Q3 results that were better than peers. The company reports a 5% growth in revenue on a year-on-year basis. The profit after tax also surges by close to around 7%. The stock is a relative outperformer in trade. Hello and welcome to Chartbusters. I'm Nigel. With me, it's Mangalam. And as you can see to the top of your screen, the Nifty is trading in the green. The Nifty Bank, that's the one that's supporting in today's trading session. However, the broader markets continue to reel under pressure, and that's why you have the breadth of the market, that only 400 stocks are advancing as of now. And you have close to around 4 declines for every one stock that's advancing. Well, let's get to our first management. The wealth management firm Prudent Corporate Advisory Services reported its third quarter earnings. The revenues came in line with estimates. However, the profit after tax declined on a year-on-year basis. To discuss the latest earnings release as well as what's the way ahead, we're joined by Mr. Sanjay Shah, the Chairman and Managing Director at Prudent Corp. Hi, Sanjay. Good morning and good to see you win. Well, market mood has got a little bit jittery. And now the street wants to see, a higher amount of growth. I'm looking at your last quarter's numbers and growth has come off a little bit. The total revenue itself has come more or less flattish. So could you tell us, what is the trajectory going ahead? I can see, on most verticals as well, we're not seeing too much of growth out there. So what is the growth guidance you can give us for the next quarter for FY25 as well as FY26?
So good morning, Nigel. I think first of all, if you look at about the Prudent, I think we have the significant revenue. Our revenue comes from the mutual fund distribution business. And the last quarter was still under pressure because of the 4.5% kind of a mark-to-market losses which is accrued. However, if you remove the mark-to-market losses, I think we did a reasonably well as far as my net sales is concerned, SIP numbers addition is concerned. I think the mutual fund distribution addition is concerned. So all the KPIs of the business are intact. However, the somewhat amount of revenue impact mainly came because of the mark-to-market losses on the mutual fund side. On the non-mutual fund side, actually, the lot of pressure came because we used to distribute a P2P product called Liquilon. And as you remember, last quarter before, I think RBI came with some of changes in distribution of P2P product. And that's the reason I think that segment is significantly under the pressure. That was number one. Number two is very small piece of broking also we have. There also, I think the last quarter was not that great, and we had the merger of Prudent broking with corporate, so that also came under pressure. And insurance was also last quarter, as you remember, a lot of changes on the surrender value. So I think first 1.5 months were definitely under pressure. So all put together from the non-mutual fund side brought the pressure. Additionally, our treasury book, which was a small amount of money which we invest into equity, there also the pressure came. So all put together, I think the top line and the bottom line both came under pressure. But I think a lot of things are one time in nature, and I'm sure this quarter should be reasonably okay.
How much better? What kind of growth can you guide for year on?
So I think again, I can tell you, we are a part of mutual fund AUM, where if I talk about the current month also, we ended the month at 1,06,000 crore. Today I'm at 1 lakh crore. So already I am under pressure of 6%. So I think the entire projection has to be based on how market behaves and how the money comes from the retail. So two pillar of my AUM, right? One is mark to market, another is new business, new SIP, new partner. So all the three parameters are very, very strong. I don't see any reason my SIP number should not grow significantly better. New partner addition, new client addition is intact. However, mark-to-market loss is only the guiding force, and which I think I'll be difficult to say anything what will happen in next 2 months.
Let's talk about the SIP part itself. From a market standpoint, it has been extremely resilient. We've seen numbers closing in towards that $3 billion mark per month as well. But, three things have happened out here. One is that the withdrawals have increased. Secondly, your monthly SIP flow market share has, fallen by about 10 basis points quarter on quarter as well. And thirdly, we've had, mutual funds like HDFC AMC and Nippon AMC cutting commissions as well. So in light of that, what is your prognosis for the SIP in terms of monthly run rate targets? I remember you were looking at around 1,000 crores. What are you at, and by when do you reach that 1,000 crore mark? And what is your target on market share out here? And if you could give us a sense of how this commission cuts helps or affects your business.
So Nigel, first of all, on the market share, we normally look at our market share in the regular plan. We do not have the presence in the direct plan. So if you look at the current market share, which Prudent has, definitely you're right, it's gone down by, I think third digit has came down. However, I think we are maintaining 3.5% on the market share. And if you look at the direct plan of about 28% into the industry, I think our market share in the regular plan is close to 5%, and we are maintaining that. Coming to your question about my 1,000 crore target, we had the target of achieving that by March 25. I think last month we added 935 crore. This month again we are expecting that we land with about at least 25 crore of addition. So I think this month we landed 960 crore with an average run rate of 20 crore, which we have done in last 12 to 18 months. I am sure we'll be close to 1,000 crore, 10 crore here and there. So I think that looks to be very, very achievable. Coming to your second question about the pressure on the margin on the back book, I think, Nigel, it has been happening mainly because there is a sudden rise in AUM because of mark to market, which AMC was not able to pass on, and the HDFC has done in their full basket, which is already in my price, which has happened in last quarter, and Nippon has done in their one or two schemes. Overall, if I tell you in the number perspective, I think the top line is not likely to be impacted more than 9-10 crore at my end, which is hardly about, let's say, for example, my total yield is about 91 basis point. I don't see a reason that it should be more than 1 basis point on the total, because if it is a 1 lakh crore of AUM, I think the 10 crore se zyada mera top line mein impact nahi aayega. Positive part is that we are the B2B player, so we'll be able to pass on at least partial to my advisors or the distributors. So I think the bottom line pressure should not be more than 6 on a total 80 basis.
All right. What about the cost to income ratio? Where does that stabilize at?
I think the overall, because the cost to income ratio, my belief is it is the existing, whatever is the level which you are reported, I think it should stabilize it there. I don't see further increase in the cost.
Okay, so around 76.5 to around 77%. All right, Sanjay, thanks a lot for joining in. You're sounding reasonably confident. Your stock is down because the street seems to be saying dil mange more. They want to see better growth in the times to come. But to be fair, from the lows of today, actually, the stock has seen some bit of a recovery. You're confident their SIP number will clock close to around 1,000 crores for you in the next few months. Thanks a lot for joining in. Well, as we slip into a short break, it's time for Growth Code, an initiative by Grow and CNBC-TV18 designed to provide you with valuable trading strategies. This week, SEBI's whole-time member, Anant shares his insights on the newly introduced F&O trading guidelines and the rationale behind these. Let's listen in.
Overtrading, particularly on expiry day index options, was creating the possibility of more systemic risk with an increase in the overall market risk right up to the time of the expiry. So these two areas, one is a systemic risk area, the other of related to investor protection, is something that we were looking at closely, and we were consulting with market participants for months together. Our consultations told us that the issue really boiled down not to the broad swathe of derivatives, but specifically to the issue of index options trading on expiry day. So it was a very clinical approach that we subsequently adopted, essentially to address this specific issue of overtrading in index options on expiry day. On October 1st, 2024, we announced a series of 6 steps to address this. 5 out of those were directly aimed exactly at this, curbing overtrading in index options on expiry day. Now, the impact of those steps are still playing out. We will watch the data very closely to see how things stabilize. As and when we come to a conclusion on what the impact of these 6 steps have been, if further steps are necessary, both for market development as well as for investor protection, we will take steps accordingly. So at this point of time, nothing is planned. We will see what the data shows, and then we will take the steps further. But there should be no doubt about SEBI's broad objectives here. We want a sustained F&O market that is conducive to capital formation in the country. At the same time, we want to ensure investor protection and we want to ensure systemic stability. And we will continue to work along these lines in consultation with all market participants.
Welcome back. Even as the frontline indices are holding on to gains, they are off highs in the broader markets. Actually, the mid-cap and the small-cap index is at the low point of trade. A couple of stocks that really are taking the plunge right now. Loris Labs, from the peak, we've seen a near 15-16 point correction, 15-16% correction on that stock itself. Fears around, business in the US are impacting the stock. We've heard the management speak yesterday as well, but, the street seems to be more perturbed than the management. Stock at the low point of trade. Alembic Pharma is the other one. We're also seeing a sharp sell-off on names like Biocon. So a lot of the pharmaceutical stocks are seeing a bit of sell-off. Also, something like a Z Entertainment and First Source along with PB Fintech are the ones which are selling off. So just keep an eye out on the broader markets, though a bunch of stocks which are actually outperforming belong to the realty space. DLF, for instance, has moved higher after some bit of profit taking that we saw in yesterday's trading session. JK Lakshmi Cement is the other one which is seeing some bit of an up move. And Balkrishna Industries, after selling off in yesterday's trading session post management comments in the conference call, that stock too has seen some bit of buying, currently sitting with a gain of almost 3%. We'll take a short break, come back, get you more on the markets and stock specific action, perhaps get closing in on one of the sectors and sector expectations in our special segment, Quarter Se Quarter.
Welcome back. Well, the outlook for the capital goods sector in Q3 reflects a mixed picture. Vamakshi joins us to help us out with more details on that and the broad expectations. Vama?
Well, absolutely, Nigel. With last year's state and central elections, government ordering activity naturally moderated and that was widely anticipated. The private sector too saw tepid capex with growth limited to select emerging segments. That said, the strong existing order books continue to provide healthy revenue visibility. On top of that, with key input costs staying manageable, companies focusing on high margin areas and operating leverage kicking in, margins are likely to remain elevated. Now let's dive into company-specific expectations. Nomura projects a 13% year-on-year uptick in ABB's order inflows. Revenue growth is expected at 14%, driven by robotics and motion and electrification segments. Margins could expand by 270 basis points, with net profit surging by almost 36% year-on-year. For Siemens, order inflows are estimated at 6,500 crores this quarter, with revenue growth of 12% driven by an execution ramp-up in energy, smart infrastructure and mobility. Margins are expected to expand by nearly 93 basis points and net profit may grow by 16.4%. The demerger status of Siemens' energy business will also be a key focus area. For Cummins, revenue is expected to grow by almost 10% on a high base, while EBITDA margins might contract year-on-year, and that is mainly on account of higher data center volumes in Q3 of last year. Exports are anticipated to see an uptick on a lower base, and key factors to monitor this time around will be the commentary on export demand, CBCP 4+ sales and pricing trends. Ordering activity for Thermax is also likely to rise 31% year-on-year to 3,290 crores, with revenue expected to grow at 16%, accompanied by a 130 basis point margin expansion. However, net profit is projected to decline by 24% due to an exceptional gain in the same quarter last year. Now, as far as Hitachi Energy is concerned, a significant highlight this time around is the anticipated HVDC order from Power Grid, with order inflows projected at 6,800 crores, a whopping 450% year-on-year increase. Revenue is expected to grow by 29%, margins by 321 basis points, and net profit is expected to triple. Reporting results later today, BHEL is expected to post a 28% growth in its revenue, driven by power and industrial segment. Ordering activity is likely to remain strong, with a 658 basis points improvement in margins. The company is projected to swing to a net profit of 175 crores compared to a net loss of 163 crores in the same period last year. So that is how the numbers are expected to pan out this time around. But what about valuations? Well, stocks have dipped in tandem with the overall market sentiment, and with that, the valuations, as you can see, have corrected substantially from their peaks in 2024. That said, brokerages are bullish on selective counters. Nomura's top picks include CG Power and GE Vernova T&D, while IIFL Capital prefers names like Cummins, ABB, Siemens and CG Power. Now, looking ahead, all eyes will be on the government's capex plans in the upcoming union budget. The capex momentum, both from the government as well as the private sector, will be critical, along with commentary on competitive intensity and pricing power.
Right, Vamakshi, thank you so much for putting that into perspective for all of us. The expectations from not just this quarter, but also from the government in the budget and private sector capex as well. We have Mr. Anwani joining in from Prabhudas Leeladhar to discuss how the sector has fared as well. Thanks a lot for joining in. You know, Vamakshi has laid the foundation for all of us out here. The question isn't about how much the government will, earmark in terms of capex, but how much they will deploy. From the year so far, how much do you think has been, deployed of the amount that was earlier earmarked? And in light of that, what's the prognosis for these stocks which have seen a bit of a correction from the top?
Right. Thanks for having me. So I think with respect to capex, as we have been hearing, because of the elections this year, till November, what we understand, kind of 50-60%, 50-55% capex is deployed across defense, power. And we are hearing from the railway documents that the railway ministry has deployed almost 75% of capex. So I think the capex this year was expected to be back-ended, though there was a slight 2-3% cut which can happen with respect to growth in capex, which was there. For this year, we were expecting 11 lakh crore of capex, which can move slightly here and there. But having said that, I think for the next financial year as well, I think the key segments like power, railways, defense definitely will be in focus, where there should be more budget earmarked. And interestingly, in power, we want to integrate the renewables, where with the objective by FY32 is to go 850-900 gigawatt, out of which 50% should be renewable. So I think if you see all the long-term vision documents of government, we see definitely the capex continuing in the key sectors. And this year, it could be 2-3% miss, which can be possible, broadly speaking. Yeah.
Okay, all right. Hi, Amit. Good to see you. And so 10.7 lakh crore, approximately 10.7 lakh crore approximately could be the number that we should be working with. On that pace, what is the number you will be satisfied with for the next year?
I think between 8 to 10% on the revised base, definitely we can see capex earmarked for FY26 as well. And as we have been seeing, there's a very strong uptick in the T&D capex. We saw a couple of HVDC orders getting awarded in past 2 months. If you see, despite the slowness, we saw the very large order getting awarded of 40-45,000 in thermal power, which L&T and BHEL won. So we are seeing there pockets where the projects are getting cleared in past 2-3 months versus the first half of this financial year. And we expect that especially defense, a lot of orders get cleared in Jan, Feb, and we are expecting
Got it. Amit, very quickly, a little short on time. Top picks, give and take everything, slowdown, valuations, margins, the way the stocks have run up. Top 2-3 picks?
Yeah, so I think we are betting on Cummins India, which is our top picks. Despite we are building in 11% growth this quarter, I expect that the export is likely to rebound now, and the industrials business is also coming back, and the CPCB transition is kind of settling down. There's a lot of scope for growth and leverage still continuing. The stock is trading at 2,700. We have a target price of almost 4,100 rupees. Second, I think Voltap, where the valuations have corrected significantly, seeing the macro tailwinds in power T&D space, I think Voltam is a preferred transformer player catering to industrial transformers and now setting up capacity in power transformers. I think the valuations have corrected significantly, and this is our topic. In defense, Bharat Electronics at 265 definitely can be looked at, seeing the kind of pipeline which we have been discussing in defense, which is still used. Yeah.
Okay,
right.
Amit, Cummins, Voltam and BEL, and you're talking about 265. In fact, as we had this conversation, it became 255. That's the kind of state of the market we are in. But there are picks out there that various people like, and you have stated them out for us. Thanks a lot for joining in and filling us in with all of those details. But we've completely run out of time on this edition of Chartbuster. Stay with us. Trading Hour comes up next.